backed and powered by 150 years of business experience. Venue is a virtual data room trusted by the best of the Fortune 500 to move deals seamlessly from one to the other to the next too.
Blockbuster semiconductor deals have dominated tech M&A in recent months, with Intel Corporation buying Altera Corporation for $16.7 billion, Avago Technologies paying $37 billion for Broadcom, and NXP Semiconductor acquiring Freescale Semiconductor for $16.7 billion. Enterprise software has also been an active subsector, attracting significant private equity investment, and in terms of M&A, among companies targeting specific industry verticals. For instance, Cox Automotive is acquiring fellow auto dealership software developer DealerTrack Technologies for $4 billion. Welcome to today's installment of Merger Talk. I'm Mark Aiello, Vice President General Manager for Venue, the virtual data room platform of R.R. Donnelley. Today I'm joined by Ed Liu, co-head of Morgan Stanley's Internet and Software practice. Ed, thanks so much for joining today.
Thanks for having me.
Thanks. Let's get started and just talk about industry multiples and where you're seeing valuations these days.
Sure. I think when we look at industry multiples, we can look back in time to the last peak, which is around 2000. The S&P and the NASDAQ are around the same level, so we're near all-time highs. However, the big difference between now and then is that these companies, these technology companies, have a lot more earnings. And so when we look at the multiples, they're somewhere in the teens, high teens, low 20s across the sector, which are much more reasonable. And so as we look at multiples, despite the market being at its all-time highs, we think that the environment for M&A is actually pretty good.
So generalized health, I guess, across the
generalized
sector.
health. I think companies, the buyers are feeling good about their stocks. They're feeling confident about where their earnings are, and so they're looking to buy. I think the sellers, because we are at a higher level, are also reasonably happy with their stocks and also in an environment where they may be okay to sell. And so I think that creates a dynamic for kind of a healthy M&A environment.
And then as you look at various subsectors, what kind of variation are you seeing among them?
Sure. I think it depends, depending on the sector. So when you look at software, I think the incumbent vendors, the large incumbent vendors, are flush with cash. They've got slower growing businesses. They're looking to find new markets. They're looking for new growth opportunities. And so for them, they're finding opportunities within cloud computing, within software as a service. These areas have been very robust in terms of M&A, which have supported their valuation levels. In the case of internet, I think that particular sector has been also pretty robust in terms of valuations. Companies getting valued off revenue multiples. Again, larger companies here, less problematic in terms of growth. The larger companies actually have growth. But they're looking for large user bases. And so, for example, when Facebook bought Instagram or when they bought WhatsApp, they were looking for very large user bases in the hundreds of millions to support their own business and to continue growing. And so I think these two areas, software and internet, have seen tremendous valuations, very significant multiples, but at the same time also quite a bit of M&A.
And we talk about large companies. Today there are more large private companies than probably ever before. How is that impacting M&A activity?
That's a great point. I think that at last count there were over 80 private companies, unicorns if you will, that are over $1 billion of valuation, private company valuation. These valuations drive the level at which other private companies want to be valued. So when public companies come knocking on their doors and looking to make acquisitions, their levels are much higher. This actually makes it a bit harder to get M&A done. We've actually seen the private company valuations exceed public company valuations in many of these sectors. Since this summer, though, there's been a bit of a correction, some of the Asian crisis and correction. That has led to public company stocks coming down a bit. That has also led to some of the private markets becoming a bit less robust. And I think that's also actually quite healthy for the M&A markets. As these valuations become more normalized, I think there'll be more activity in the space. But heretofore, it's been very hard to buy a private company.
And what impact is activism having in tech M&A?
Yeah, so activists are actually playing a pretty significant role, and they run their screens on companies of certain growth rates, with certain profitability profiles. They look for slower growing businesses, perhaps that are a little bit out of favor, that are not hot businesses, that have strong business profiles, strong profitability, but they're looking for a particular angle. Maybe it's not well run, maybe there's a business that needs to be sold, maybe they can optimize the business portfolio. In this case, there have been activists that have then agitated for change, which has led to transactions getting done. Some of the larger software deals were instigated oftentimes by an activist that then led to a sale of the business. And so these deals, I think another element of this is that the private equity sponsors are also pretty active in the space. They're flush with capital. The top 10 private equity firms have, I think, over $80 billion of investable capital. Their activity in the technology space has doubled in the last 5 years, so they're becoming much more active. They very much love software businesses. Why? Because these are assets that have growth, that are predictable, and oftentimes have very large maintenance streams and highly profitable and cash generative. So it makes for a very interesting private equity deal. And so I think the confluence of factors for some of these companies agitating for change, and then the private equity firms ready to step in, has led to some consolidation within the software space.
When you talk about private equity, are there fundamental differences between how strategic acquirers and financial acquirers approach technology M&A?
That's a good question. I think for the strategics, clearly they're looking to have some kind of synergy, some kind of strategic synergy, whether it's a common market, a common customer, some way to meld their technologies together. They're looking for that strategic synergy. I think for a financial investor, they're looking typically to generate a return. How? It could be through a synergy with an existing portfolio company, but it also could be through use of financial leverage, through use of debt. The capital markets have been robust in the last couple of years, particularly the debt markets. There's ample capital. The capital is also pretty attractively priced. And so that creates a strong environment for LBOs to get done. And I think so financial investors are a little bit less strategically focused, and then the strategics are obviously looking for synergies.
Great. Ed Lieu of Morgan Stanley, thank you very much for joining. For more merger talk, visit thedeal.com.